The financial analyst at the Securities and Exchange Commission who first reviewed CaaStle's investor documents later described what she found as a discrepancy that grew larger every time she looked at it. The company had told investors it generated $439.9 million in revenue in 2023. The actual number, verified by auditors, was 15.7 million. Not a rounding error, not an accounting dispute. A fabrication off by a factor of 28, and that was just the number they chose to show one set of investors. In the criminal complaint filed by the Southern District of New York, prosecutors described what the SEC had found: a scheme built on, quote, forged documents, fabricated audits, and material misrepresentations to hundreds of venture capital investors, a scheme that had been running, undetected, for 6 years. This is the story of CaaStle Inc. and of Christine Hunsicker, the Princeton-educated entrepreneur who built it, celebrated it, and ultimately admitted in federal court to defrauding investors of more than $300 million. You are watching The Reckoning Files. I'm your narrator. We document betrayal in business, in institutions, in the spaces where trust is the only currency that matters. Every case we cover ends in a reckoning. This one is no different. While investors were pouring billions of dollars into direct-to-consumer startups, one company appeared to offer something more sophisticated than another subscription box. CaaStle wasn't selling clothing. It was selling the infrastructure that would let every major fashion brand in America run a clothing rental program without touching a single logistics challenge themselves. The idea had genuine elegance to it. Consider the problem it claimed to solve. Major fashion brands invest millions designing seasonal collections garments that are meant to be aspirational, to pull customers into stores. But when a customer arrives, they mostly buy basics. The aspirational pieces sit on racks. They get marked down. Eventually, they go to outlets. The brand loses money on the very items that built their identity. Christine Hunsicker's answer was rental, not consumer-facing rental that already existed with Rent the Runway. Hunsicker's proposition was business-to-business infrastructure. CaaStle would partner with brands and retailers, take control of their inventory, and power a subscription rental service on their behalf. The brand kept the relationship with the customer. CaaStle handled the technology, the logistics, the cleaning, the returns, the shipping, everything. By 2019, the company claimed to operate from distribution centers in Columbus, Ohio and Phoenix, Arizona, employing 500 people across the United States and India. Its brand partners included Express, Ann Taylor, Ralph Lauren, Banana Republic, Bash, and more. It had shipped over 3 million rental boxes as Gwynnie Bee before rebranding. Its founder had been a panelist investor on a Lifetime television show. She had appeared on The Today Show. Christine Hunsicker was a Princeton graduate in Medical Studies who had improbably become one of the most celebrated entrepreneurs in American fashion technology. Crain's New York Business named her to its 40 Under 40 list. Inc. magazine called her one of the most impressive women entrepreneurs. The letter stated that Christine Hunsicker had provided certain investors with, quote, misstated financial statements and falsified audit opinions. It described the company as facing, quote, a severe and immediate liquidity problem. All employees were furloughed. The company that had told investors it held hundreds of millions of dollars in cash as recently as mid-2024 had ended its 2023 fiscal year with less than $1 million in the account. According to the federal indictment filed in the Southern District of New York, the fraud began in February 2019. At that point, CaaStle was genuinely operational. It had real employees. It had real distribution centers. It had real partnerships with fashion brands. The business existed. It simply did not generate the revenue, or hold the cash, or carry the valuation that Christine Hunsicker was telling investors it did. The mechanism was straightforward in structure and systematic in execution. Hunsicker received CaaStle's actual internal financial statements, the real numbers, prepared by the company's own accounting staff. She then altered those statements. Operating losses became operating profits. Net losses became net gains. Actual revenue figures were replaced with fabricated ones. The altered documents were then provided to existing and prospective investors. She also provided investors with fabricated audit reports documents purporting to show that an independent auditor had reviewed and verified CaaStle's finances. According to the SEC's complaint, these audit reports were doctored. The auditor's opinion had been falsified. For year 1 2019, the discrepancy was contained. The company was raising capital in a bullish venture environment. The lies were large enough to secure funding. They were not yet so extreme as to invite immediate scrutiny. By year 2, the gap between what CaaStle was telling investors and what its books actually showed had grown. The SEC's complaint states that the discrepancy grew, quote, in magnitude year over year. Each round of false financials required the next round to be larger in order to maintain the fiction of a growing company. By year 3, 2021, CaaStle's real financial condition was deteriorating. Revenue was the secondary transaction lie operated in parallel. Hunsicker told multiple investors that their capital would go toward purchasing discounted shares from existing shareholders who needed liquidity, including, she specified, investors who had been hurt by the 2022 collapse of the FTX cryptocurrency exchange. In reality, according to the indictment, these were not secondary transactions at all. Investors were purchasing original issue shares directly from CaaStle. Their capital went into the company. Their interests were diluted, and the capitalization tables they received had been falsified to conceal the new share issuances. In year 6, 2024, Hunsicker expanded the scheme. She had co-founded a second venture with retail executive Brendan Hoffman, P180, a fashion-focused acquisition vehicle designed to purchase clothing brands that would utilize CaaStle's technology platform. P180's entire premise rested on CaaStle being what Hunsicker said it was: a company with hundreds of thousands of subscribers, hundreds of millions in revenue, and dominant logistics infrastructure. P180 raised capital and took out loans based on those representations. It acquired a majority stake in Vince Holding Corporation, the NASDAQ-traded fashion brand, in January 2025. Every dollar committed to P180 was committed on the premise of CaaStle's fabricated financial statements. In 2023 and 2024, Hunsicker submitted fake audit reports to 2 separate investors. In 2024, even as a board investigation had begun, she continued raising capital. In one documented instance, she forged the signature of a CaaStle board director to make it appear that the board had authorized the issuance of stock options to an investor. That single transaction raised more than $20 million. Hunsicker also used falsified information about CaaStle's finances to obtain a $20 million personal loan from a bank. The total raised for CaaStle through the fraudulent scheme, more than $275 million. The total raised for P180 using CaaStle's false financial representations, an additional $30 million. The SEC's complaint, filed July 18, 2025, states that the discrepancy between CaaStle's actual results and Hunsicker's misrepresentations grew year over year, ultimately culminating in false financial statements that overstated revenues by more than, quote, 7,300%. The collapse did not happen all at once. According to court filings and reporting by Axios, the board of CaaStle became aware of Hunsicker's misrepresentations in December 2024. A board investigation began. Hunsicker was prohibited from soliciting new investments or selling her shares in CaaStle or P180. She continued, in February 2025, despite the board's explicit prohibition, Hunsicker attempted to sell an additional $19 million of her CaaStle shares to another investor. In March 2025, law enforcement agents seized her electronic devices. According to the criminal complaint filed by the United States Attorney's Office for the Southern District of New York, even after the FBI had seized her devices, Hunsicker continued to meet with an investor regarding a fake audit without disclosing that the audit was fraudulent, that she had been removed from the board, or that she was prohibited from selling shares. The CaaStle board sent its letter to shareholders on or around March 29, 2025. Hunsicker resigned as CEO on April 1st. Employees were furloughed. P180 filed its lawsuit in the New York Supreme Court on April 18th, describing the alleged deception as, quote, one of the largest frauds in history. The complaint alleged that CaaStle had only a few hundred actual subscribers despite having told investors it served hundreds of thousands. It alleged that the company had under $20 million in 2024 revenue despite claiming to be approaching $1 billion. On June 20th, 2025, CaaStle filed for Chapter 7 bankruptcy liquidation in Delaware. The filing revealed assets in the range of $10 to $50 million and between 200 and 999 creditors. $530 million in venture capital had flowed into the company across its history. Almost none of it remained. On July 18, 2025, Christine Hunsicker self-surrendered to federal authorities. She was charged in a 6-count federal indictment, 2 counts of securities fraud, 1 count of wire fraud, 1 count of money laundering, 1 count of making false statements to a financial institution, defamation, and 1 count of aggravated identity theft. She pleaded not guilty. The SEC filed its parallel civil action the same day, charging Hunsicker with violating the anti-fraud provisions of the Securities Act of 1933 and the Securities Exchange Act of 1934. The SEC sought permanent injunctive relief, disgorgement of ill-gotten gains, civil penalties, and a lifetime officer and director bar. For the next 7 months, the criminal case moved through pretrial proceedings. On March 4, 2026, Christine Hunsicker appeared before U.S. District Judge J. Paul Oetken in Manhattan Federal Court. She pleaded guilty to 1 count of securities fraud. In her allocution, the statement a defendant makes to the court confirming their guilt, Hunsicker stated, "Beginning in February 2019, I knowingly provided false statements about CaaStle's finances to current and future investors." As part of her guilty plea, Christine Hunsicker agreed to forfeiture nearly $300 million in proceeds from the fraud. She faces a maximum sentence of 20 years in federal prison. Sentencing is scheduled for August 5, 2026, before U.S. District Judge J. Paul Oetken. The consequences extend well beyond the sentencing courtroom. Hundreds of venture capital investors, the indictment specifies the number in those terms. Hundreds committed capital to CaaStle and P180 based on fabricated financials. Most of that capital is gone. CaaStle's bankruptcy estate listed assets of $10 to $50 million against debts incurred from over $500 million in fundraising. The employees who worked at CaaStle's distribution centers in Ohio and Arizona, people who loaded boxes, processed returns, cleaned garments, managed logistics, were furloughed with no notice in April 2025. Many lost their positions entirely. The fashion brands that had built rental programs on CaaStle's platform, programs marketed to their customers, staffed by their employees, found their rental infrastructure had been built on a company that was functionally insolvent. Ralph Lauren, Ann Taylor, Banana Republic, Express, Bash, and others had their rental programs either shut down or left without an operational partner. P180, the acquisition vehicle founded on the premise of CaaStle's represented capabilities, had taken out loans and raised capital based on those fabrications. Its investors lost more than $58 million. The Vince Holding Corporation acquisition, completed in January 2025 on the basis of CaaStle's false representations about the platform it would provide, was completed days before the fraud became public. U.S. Attorney Jay Clayton, in his statement following the guilty plea, said, "Christine Hunsicker fashioned a massive fraud scheme built on forged documents, fabricated audits, and material misrepresentations to hundreds of venture capital investors. Today's guilty plea sends a clear message. Individuals who exploit investor trust for personal gain will be held accountable. Fraud in the venture capital ecosystem not only harms investors financially, but also undermines innovation and confidence in emerging businesses." Clayton added, "The promise of pre-IPO technology companies can be fertile ground for fraudsters who play on investor euphoria. Investors should be aware that pre-IPO companies are not subject to the rigors of SEC registration. This office is committed to protecting investors who place their trust and capital in emerging companies. The SEC's parallel civil action remains active, seeking disgorgement, civil penalties, and a lifetime ban on Hunsicker serving as an officer or director of any public company." The fashion rental industry that CaaStle once claimed to be transforming has largely retreated. Ralph Lauren, American Eagle Outfitters, Banana Republic, the brands that briefly offered rental services through CaaStle's platform, have wound down those programs. CaaStle's collapse is, per reporting by the Business of Fashion, quote, "the clearest sign yet that rental's future lies elsewhere." CaaStle's fraud lasted 6 years because every document Hunsicker presented looked like the document it was supposed to be. The audits had the right headers. The financials had the right columns. The numbers were specific, not round, not approximate specific in the way that real data is specific. That is the mechanism that every large-scale financial fraud exploits. Not greed alone, not complexity alone. The fabrication of the signals that sophisticated investors have trained themselves to trust. We tend, after cases like this one, to ask how investors were deceived. But the more useful question is this: what would it take for the deception not to have worked? Real-time independent verification of financial data, audits that cannot be doctored, mechanisms that would have made a 7,300% revenue overstatement visible before 6 years had passed. Christine Hunsicker is scheduled to be sentenced on August 5, 2026. Whatever sentence judge hands down will not restore the capital that was lost, the jobs that ended, or the rental programs that no longer exist. The reckoning is real, and it is incomplete. If you found this case significant, there is a link in the description to the SEC enforcement release and the DOJ press statement, both primary sources, both public. Read them. The documents are worth your time. Subscribe to the Reckoning Files. New episodes every Thursday. And if this story matters to you, share it with one person who needs to understand how these systems fail and what it costs when they do.